Well, we caught a little more of the Reserve Bank's thinking this last week. On Tuesday, rates, of course, on hold again at 0.25%. Its QE seems to be working. On Thursday, in its financial stability report, the RBA said Australia's financial system is well placed to, quote, absorb rather than amplify the effects of the pandemic. But it also noticed that how COVID-19 will affect residential property prices remains unclear. Leo Shanahan spoke with Westpac's senior economist, Matt Hassan.
I think the decision this week from the RBA was more a reaffirmation of its policy measures to date. There's not a whole lot of additional room to manoeuvre. The RBA is still very against moving rates into negative. So with the cash rate at 0.25 and some technical limitations on taking it further below 0.25, the cash rate is essentially at its lower bound. So its decisions at the moment are more around its other policy measures. And I think on that front, they are fairly pleased. I think they should actually be commended on their response so far. It has been quite successful. Their targeting of the three-year bond rate has been very effective. The three-year bond rate is now essentially on the RBA's target of 0.25. And its asset purchases, government bond purchases, have also been quite successful in holding the shape of the yield curve down more generally. So I think the decision this week, given that that was an intermediate emergency rate move and QE move mid-month, was really about reaffirming those decisions and committing to holding policy at very easy levels and accommodative settings for the foreseeable future. I think aside from that, they are obviously watching and waiting to see what their policy impact is and what the bottom line hit to the economy is likely to be, as well as how the virus situation pans out.
Yeah.
So I think for now, not too much to read into the RBA at the moment.
To turn to property, some have been predicting large-scale falls in the property market. Will take a bit of time for those to wash through. Of course, auctions nosediving because the restrictions around them and even the ability to put a house on the market at the moment. What are you seeing in terms of both the housing market and availability?
So it definitely looks poised for a sharp slowdown in activity. As you mentioned, the auction channel is pretty much shut, apart from those who manage to go through online sales channels. In terms of the price effect, I suspect that's going to come through a little more slowly. It's a bit of a difficult one to judge at the moment, even in terms of market turnover. Yes, there's negatives. The social distancing requirements preclude auctions, preclude open homes, and more generally, it's discouraging people from going out and searching for property and so on. That said, technically, in New South Wales, at least, the social restrictions to only travelling for essential reasons, those essential reasons do actually allow for viewing properties. And while the auction market has closed down, and we've got clearance rates in the low 30s because nothing's able to go right away to auction, that channel gets a lot of coverage because it gives us a lot of timely data. But the bottom line is, in terms of sales, it only accounts for 15 to 20% of sales across the whole market. So it's very important in parts of the Sydney and Melbourne markets. But outside of that, private sale through these sort of one-on-one viewing channels and private negotiations are more common than auctions. So it is plausible that we still get, we don't go to the 80, 90% catastrophic drop in turnover that we just see switching to online and private sales channels, and we still get some ticking over. I think, though, near term, it's going to take a while for people to adapt to moving properties that way. And I think more generally, we've obviously got a shock to the economy coming through, so that economic uncertainty, job insecurity, all these issues are likely to be very disruptive, and on their own will trigger a pretty sharp decline in activity across the real estate sector.
As far as investors and investors from overseas in particular, and the restrictions we have on travel and migration at the moment, how much is that going to affect the market, do you think? Can some of these buyers still buy, for example, from overseas via the internet?
I would suspect that if they're purchasing online, there's still that option there. But you'd have to say it'd be a very bold foreign investor at this stage to pile in. Not with so many uncertainties, including around the ability to actually travel to the property that you're planning to purchase. I think where it's more important, where the more important linkages are from the foreign migration and foreign buyer perspective, is how the virus outbreak may affect migration patterns over the medium to longer term. We know straight off through 2020 we're going to see essentially no migration flows, both inbound or outbound. In fact, we're going to see non-residents returning to their home countries in many cases. But beyond that, even once we get past the worst of the virus health concerns, it's hard to envisage going back to a world where free travel is something we can go back to. There'll definitely be some sort of quarantine restrictions for a time. And for many contemplating migrating or studying in Australia, that'll be a pretty big issue, I suspect. People will be concerned that we may get a renewed outbreak of this virus. You could end up being stranded in a foreign country, and you're just not sure how that situation may play out. And I think more generally, people are going to be a little bit traumatised about travelling in general. So I think that's really important because the migration inflow to Australia accounts for about 1% of our population growth. If that slows materially, our growth prospects slow materially. It also has a feedback through demand indirectly for the physical demand for housing in Australia, which is a big part of the price performance of the market. So I think it warrants careful consideration. There's also a policy angle to this. I think a high unemployment economy is unlikely to seek strong inflows of workers, for example. I think it's one of the key dynamics for the housing market once we get beyond what is a very large shock, direct shock from the disruption of the virus.
All right, Matt Hassan, thank you so much for your time.